now.
Thanks. Hi, everybody. I'm Amelia Bourdeau. Thank you for joining in the webinar, and thanks for the invite. I appreciate it. I'm based between New York City and Florida, so I go back and forth. This is the start of my presentation. I'm going to talk about event risk in Forex, which is very prevalent right now, as there's clearly a lot of event risk in the market. This is a photo on the cover of the subway station in New York where I would get off. I actually worked on Wall Street. I mean, I worked on Wall Street, but I actually worked on Wall Street at Deutsche Bank, where it's located, for 5 years throughout my career. I'll tell you a bit more, but this was actually my subway stop that I got off of, so I took this picture. This is the 19 right on Wall Street, and at the top of those stairs is Deutsche Bank. As a disclaimer, you know that trading obviously is risky, so only trade with money you can afford to lose. Basically, trading is very risky for people of all levels, for sure. My company is Market Compass LLC, and this is my website, www.marketcompassllc. I like to present this at the beginning because sometimes I forget at the end or we run out of time. So if you just go and fill out that little box there, name and email, you'll get a free download. It's a series of 5 videos, 5 short videos, and 5 PDF trading tips that'll come to you over about a 7 to 8 day period. And these are a guide of 5 techniques that retail traders can use to navigate the markets like the big hedge funds do. I'll tell you why I know how they do in a minute, but that's free. And you'll also get on all my distribution blogs as well for videos and blogs. We're going to talk about event risk today, and I have a webinar specifically on event risk. And so you can go and sign up for that. That's a paid subscription. It's in the webinar tab. It has a video where you can learn about the webinar and also where you can sign up. So I just want to call that to your attention. You can follow me on Twitter at Amelia Bourdeau. I update intraday on Twitter, and I also update on Instagram story at Market Compass intraday as well. And I have a YouTube channel. I'm just kind of starting out on that, called Market Compass, which has some market videos on it. Just for a background, it's not to be egotistical, it's just trying to show you how I approach market. So I was a macro trader on Wall Street. I specialized in foreign exchange. So I worked 17 years on Wall Street. I worked my entire career in the global markets divisions of banks. And I also worked for a couple hedge funds. I'll get to that in a minute. And global markets is FIC, so that's fixed income, foreign exchange, and commodities, basically. So I was in FX sales and trading and FX strategy throughout my time on Wall Street. On the sell side, which means the banks, I worked at Deutsche Bank. At the time was the world's largest foreign exchange trader. I worked at UBS, which is Swiss bank, which went 1 and 2 at Deutsche Bank when I worked there for the world's largest foreign exchange trader. I worked at Westpac and UniCredit AGA, which is half German, half Italian. So Westpac Bank especially, obviously I specialized in Asian currencies and Australia and New Zealand, the dollar block. Deutsche Bank and UBS was G10. UniCredit was mostly G10 and a little bit of Eastern Europe. I also worked on the buy side. That means for hedge funds. I worked for 2 macro hedge funds as well. They were both in New York, but one was also based in Australia. So I used to go back and forth between Sydney and New York, which is a much longer commute than Florida and New York. And I started my career at the Federal Reserve Board in Washington, D.C., and I was in the International Finance Division. I started there during Asia financial crisis. So it's kind of interesting. Asia's been a little bit of a theme throughout my career. You might have caught me a while ago on CNBC for Money in Motion. I have my own show, myself, Todd Gordon. And now you can kind of catch me on Fox Business News with Mornings with Maria and Yahoo Finance. Here's just some of the stuff that I've done where I've worked. The reason why working at Deutsche and UBS was important was because I interacted a lot with the world's largest hedge funds. Those are obviously who the clients are for foreign exchange, especially as we are the world's largest foreign exchange traders during the times that I worked there. And so that helps me go and speak to them on the phone every day, sometimes, place orders for them, execute trades. And so I really get to learn how they trade and how they look at the markets as well. So I approach my FX trading like I did during my professional Wall Street career, as a macro directional trader. So what is global macro trading? Let's just define it so we're all on the same page. That means it's a top-down view across all markets and economies. Market themes drive the directional trade ideas. So macro trading is generally directional, and market themes or macro themes, I use those interchangeably, those drive the trade ideas, and that's important. And we're going to get to more of that in a minute. Macro trading is discretionary, so it's not rule-based, it's not algo-based, and it's flexible, so you can take into account a range of different types of market conditions. Market themes, as I mentioned, is really important to my trading, to macro trading in general. Market themes evolve, okay? And we track, it's important to track how market themes evolve because that generates trade ideas, and that also alerts you as a trader to potential pitfalls ahead, potential risk events. So market themes evolve as a result largely of event risks. So it's really important to know what types of event risks there are and obviously track them. And obviously event risks can form a roadmap to market trading, to direct your trade ideas. People have often asked me, I get this question once in a while, well, if you're just looking at event risk, aren't you just trading the news? And being aware of event risk or trading or not trading an event risk is also important, is not trading the news. What you're identifying in macro trading is a big market theme. And that's the theme that's driving the market. And events kind of control the direction of the theme. And so you change your trade ideas or you shift your positions based on how these market themes develop or evolve. And sometimes news is certainly a part of that. Sometimes data is a part of that. Sometimes geopolitics is a part of that. So you'll learn more as I go along in the presentation. I'll show you what I mean. But event risks can happen usually in one of three ways. They happen as an external shock. They happen as data, so economic or financial data comes out. And politics, as I mentioned, and geopolitics. So things like general elections in countries, policies, or trade negotiations. Those are some examples of event risks that I track. In macro trading, volatility is your friend. So macro and foreign exchange, macro trading, directional trading shines in times of kind of chaos and volatility. So that's when it typically does well. Why? Because you want a big directional move, and big directional moves tend to happen when there's a lot of volatility in the market. So keep calm and trade on is the macro trader's expression. I just want to move this box. I hope you can see the VIX. That's the VIX index here. Obviously, it's spiked very recently. We know what's happening in the market with all the coronavirus and the US equities on a roller coaster ride here in the US. So we did hit a high of 40.11. Anything over 20 is considered on the VIX volatile market. So heading up to 20, like 18 to 20, a little bit of volatility. And if you see when the VIX index breaks 20, it usually does so in a very decisive way. It doesn't usually just poke its head above 20 and come back. It usually is decisive break. So one of the last decisive breaks was here in December 2018, and that's when the Fed hiked rates and the market didn't agree. The Fed didn't like that. So volatility spiked. We had a little bit here in August, and that's when of 2019, and that's when China depreciated its currency through the 7 level. It disrupted global markets. But here the spike is really, really large, and you see how fast it was. So very volatile. Even though we're come back a bit, we're still around 37.5 today, so still volatile markets. And people are asking, a lot of people are asking in general for trading advice, and you're certainly seeing this discussed on television. Should we buy the dip? Should we buy the dip in equities here? And if you're going to buy the dip in equities, I'm not saying yes or no, but if you are going to buy the dip in equities, you should be very aware of where the VIX is, where volatility is. So knowing that it's around 37, you're still in for a roller coaster ride. So if you're buying dips in equities, you're doing so on a value, you're picking stocks on a value basis and on a longer term basis for a hold. It's not a short-term trading strategy right now to do that. That's something you're going to scoop at a lower price, some stock that you like for a value, a fundamental reason, and you're going to hold it for quite a while. Why? Because we know with VIX elevated, you're going to be in for a roller coaster ride until the VIX comes down to 20 and below. Event risk. Mitch mentioned why event risk is so important. And the first type of event risk I talked about, which is obviously very precedent right now, it's driving the market, is an external shock. And let's define an external shock. An external shock is an unexpected change impacting the economy or financial markets, which takes place outside of them. So an external shock is external. It's not internally generated by markets. It's not a bad payroll number in the US. It's not a bad economic result. It's definitely an external shock, something coming that you don't expect or see. And you know what it is. The external shock that's rotated to the forefront that we didn't expect to see, nobody was talking about this in December, is coronavirus. So here's a photo from the Washington Post on February 18th. Very sadly, the director of the Wuhan hospital actually died of coronavirus in China. But in late January, early February, coronavirus was largely contained to China, and that's when we were first hearing about it. There's been a rotation, as I said, in market themes and themes that are driving the market. Obviously, this external shock in terms of an event risk, and the event risk in terms of an external shock, that rotated to the forefront, that was coronavirus. Why does it matter so much? Well, it matters obviously from a global health perspective and a personal health perspective. It also matters what began in China has slowly, actually not so slowly, spread out around the world. So China growth slowdown, the first thing we have to look at is the China growth slowdown. That's the first thing the market considered when they first heard about coronavirus. So China being the world's second largest economy, when it has a massive growth slowdown, as it will show in the data soon, to what extent is it slowing? It's been hard to forecast the extent to which China is going to slow, but we know it's slowing precipitously. And to what extent the economies that are most closely linked to China, are they going to slow as a result of China's growth slowdown? And then, of course, the coronavirus has now spread around the world, and we're looking at things like the Tokyo Olympics possibly being canceled. I signed up to run the Paris Marathon in April. The Paris Marathon has been canceled. They're talking about canceling the London Marathon in March. So large events around the world are being canceled. This is important because these events bring in tourism and money and business spending, and it's important that large gatherings globally are now being canceled. You've heard of meetings and investor days being canceled here in the United States as well as coronavirus spreads, as there's more cases. So the Fed cut rates 50 basis points, an emergency move a couple days ago. And one of the reasons why is a supply shock can actually become a demand shock. So when we talk about China, we talk about suppliers and factories closing, not generating enough goods to be sold. Some sort of supply shock can then feed into consumer confidence and become a demand shock. People stay home, people don't shop. They hear about a shortage of goods, a shortage of food, around the world. I'm not just talking here. And they stay home and they kind of retrench from all spending. And that's when a supply shock becomes a demand shock. And I think that's definitely one of the reasons the Fed cut rates. If we just look quick, this is from the World Health Organization. They update this live every day. The snapshot was taken a few hours ago. It really tracks on this side. This is an interesting chart, and it corresponds, I think, with financial markets. This is the number of cases per day that have been recorded. And you see how it slowly started towards the end of January and then really ramped up and exploded in mid-February. You see the map and the number of cases here on the right-hand side. Total cases, 80,565 in China. There's 95,270 in the world. 80,565 of them are China. Next, the Republic of Korea, Italy, Iran. The Diamond Princess ship in Japan. And then Japan itself. The US is a bit lower. at 129 cases. So we're just watching this carefully. I watch this closely every day. Now, what happened to the market? So I just want to talk about what happened to the market so we can understand where we are and where we can go from here. So what happened was we were doing pretty well. This is a S&P 500 is the purple line, and the VIX is the red and green line. So we were doing pretty well. On January 15th, the US and China signed their phase 1 trade agreement. So stocks are rallying in the US. We kept reaching kind of all-time new highs every day back in the middle of January. And look, this is the VIX index, the red green line. It's low. There's that 20 marker, and we're way below it, trending lower even. Then all of a sudden, around January 23rd, if you look at that WHO chart back on the previous slide, that's when we kind of started to hear about this thing called coronavirus. We first started to hear about it. And we had some off days in equities, but you know, volatility rose, but it certainly didn't come near 20. And then the market kind of brushed it off, at least in terms of the United States, for about another week. And we reached a new high, S&P 500. And then all of a sudden, it got much worse. The cases spread. The cruise ship patients were released in Japan, and it was thought perhaps, you know, now the virus can spread. They were under quarantine and they were released after their quarantine period. And then cases started to appear in the United States. And the equity markets got really nervous. And of course, we had giant falls, as you know. So here's a giant fall repeatedly in the equity market, and commensurate with that, the VIX spikes. It just blows up to a high of 40. So volatility explodes and US equities tank. Now let's look at what the dollar index did initially. So here's that January 23rd when you start to hear about coronavirus. So the dollar index was kind of weakening. It wasn't weak, but it was just getting weaker. It was kind of trading sideways. And then when we started to hear about coronavirus, that's when it really started to take off. So the dollar massively strengthened during the initial outbreak of coronavirus in China and in Asia, when it was largely contained, especially to China and then just to Asia. And then the equity market decided to tank when we saw that the cases were coming to the United States and into Europe outside of Asia. And the dollar index receded again massively, very quickly. So let's kind of take a look at why that was. So the US dollar index initially shifted much higher with coronavirus, much stronger. So why? Because the US dollar is a safe haven currency. And are there other safe haven currencies? Yes. The Japanese yen and the Swiss franc are the other Swiss haven currencies. And is there another safe haven asset? Yes, gold. So the safe haven assets are dollar, yen, Swiss, and gold. And that's important because in this whole coronavirus outbreak, this external shock that we're talking about, the safe havens do rotate. It's not always one safe haven that is the consistent safe haven. So this is just the US dollar index chart with now the Dow Jones Industrial Average in the blue line. So it's interesting, we peak here when US equities peak, so the dollar peaks when US equities peak. We can't quite get to that really important level on the dollar index 100. That's a huge resistance level for multi-year in the dollar index. So that's rejected. And at the same time, equities turned down massively. This is the Dow Jones. You know, we were down like 1,000 points a day. We were down 1,000 points a day today at one point. And as this happens, the dollar weakens. So the safe haven rotates, the safe haven asset rotates. It was the US dollar strengthening at the start of the coronavirus epidemic, and then it rotates. So it's no longer the US dollar right now due to the massive falls that we're seeing in US equities. So the safe haven currency, the safe haven asset changes. And let's look at what dollar yen does, because I mentioned yen is also a safe haven currency. So here at the start, this is the Dow Jones again, the blue line, and this is dollar yen and the red and green line. So when dollar yen is rising, the dollar is getting stronger and the yen is getting weaker. And when it's falling, the reverse, the yen is getting stronger. So if we look at what happened, up until the peak in US equities. This was the start of coronavirus. It was contained largely to Asia. Japan also had a terrible Q4 GDP number during this time that was released. The Tokyo Marathon was canceled, all but for elite runners in January. So Japan had a lot of bad news. So dollar yen strengthened. So the yen weakened against the dollar. Here is the dollar being the world's safe haven currency until US equities peak. Then US equities start to fall tremendously, become very volatile and fall precipitously. And so the center of risk now shifts. It shifts from Asia being the center of the coronavirus back to the rest of the world because the cases are spreading around the world of coronavirus. And now the US is a problem because the US equities are falling so much and so precipitously. So the center of risk switches kind of from the outbreak in China, and the market switches its attention to the US equity market and how heavily it's falling. And so yen strengthens really tremendous amount. We'll look at a chart just, it really reverses. You see that peak and the drop with US equities of yen really strengthening. People rotate out of the dollar and into the Japanese yen as their safe haven currency. So before we look at some levels, why does this happen? This is a very simple explanation. And I think right now you can think of the explanation as quite simple. On my global macro event risk webinar, there's a more, I don't want to say complicated version of this, but there's a larger version of this, which we review, and I try to help people understand what could shift. So how do you know which safe haven currency to choose? And we're going to take this example of coronavirus that's happening right now in the market. So where is the bad news location? You always have to ask, is it Asia? Is it in the US? Or is it both? So initially it was in Asia because that's where the initial cases of coronavirus were contained to. And then are US equities up or rallying? Are they rallying or are they falling? And when I mean falling, I mean not just a little, like are they falling pretty badly, like 300 points on the Dow to, you know, over 300 points to 1,000 points a day. Let's hope it doesn't fall any more than that. And if the answer is if they're rallying, like they were initially at the start of the crisis, then the safe haven of choice would be the dollar. If the bad news location is in the US, which is largely driven by, you know, US equities falling, a bad payroll number on Friday maybe, if are US equities up or rallying? Probably not. So if the answer is no, then the safe haven choice is the yen. You'd want to be long the yen. Now, what if everything's just bad everywhere? Asia and the US, equities are falling, not only in the US, they're falling globally. Then gold is the safe haven choice. And gold has certainly rallied over this crisis. And there's structural underlying reasons why gold can continue to rally. But gold is kind of the safe haven of last resort. When truly everything is wrong, usually gold is the safest safe haven, I like to say. But that's not always the case, that everything is wrong. And so if things are just wrong in one area of the world or one region, then you have to go through kind of a checklist. Where is it happening? Why is it happening? What are the local equity markets doing? And how are US equities responding to that? Let's just look at dollar yen levels. So this is dollar yen. When it's going up, the dollar is getting stronger against the yen. And when it's going down, the yen is stronger. We kind of we rejected that big level in the dollar index at 100. We actually broke a huge level in dollar yen to the upside, a huge resistance, 112 the figure. We only traded just a little bit above 112.07, and then it came down, and it came down really quick, as quick almost as US equities fell. So we blew right through support at 110, right through support at 109, at 108, and today we blew through 107. That was today to the downside, and it was 106.65 when I made this chart. We had moved lower to, I think, 106.30. 106 is a big level in dollar yen. That's the next one to watch. And then we have, after that, the low, 105.27. So what will we need to get down there? What would drive dollar yen lower down to those support breaks would be massive, large continued falls in US equities is what would drive dollar yen lower through those levels. Let's look at the dollar index. This is the dollar index of DXY. So when it's moving higher, the dollar is getting stronger. And when it's moving lower, the dollar is weakening. So you see it's rejected right above that really important 100 level. And it comes down as US equities come down. Today it broke 90, it broke 97. Yeah, it broke 97, the figure. We traded slightly under at 96.93. 96.90, 96.50 is the next support, and then 96 the figure, which takes us all the way back to June 2019. So those are levels to watch. Once again, what would drive that is a big risk-off move, continued falls in US equities that would cause downward movement in the dollar index as the yen strengthens. I wanted to talk about Eurodollar, and you can really only talk about it right now in the context of the dollar index. So obviously there's two sides to Eurodollar. There's the euro and there's the US dollar. And what's been moving it is the US dollar right now. So it's just the big shifts in the US dollar have moved the euro. So basically, euro dollar is the red and green line, and US dollar is the black line. So here's a dollar index, almost up to 100, massively plummeting as equities falls. And as the dollar really gets strong, the world safe haven currency, it really gets strong when we hear about coronavirus, euro tanks, right? Euro goes sub 109.50 all the way to sub 108, the figure. Was a pretty big level to break. We got to the low 107.82, one spot 07.82 on euro. And then just as soon as we got there, we knifed. It just came flying right back in our faces. And that's because US equities fell and the dollar weakened. So the euro really hasn't done much. It's the dollar move that's propelled it higher. It's all the US dollar moving. And so if we just look at top side, now resistance on euro, if US equities continue to fall, and we've had good days and bad days. So yesterday they didn't fall. Today they're down a lot again. Until US equities stabilize, and what needs to happen for US equities to stabilize, as I talked about in the very beginning, the VIX index needs to come down. Volatility needs to come down. We need to get below that 20 level or back towards that 20 level, so we're not in such a roller coaster every day. So that's important to watch. But the next top side levels we're watching on Eurodollar is 113, the figure. You see that high, 113.97. So that's basically 114 resistance top side. So, but just as fortunes change in US equity trading, so can the fortunes of the euro, because they're being driven right now solely by the dollar. What we need to look for is next week, the ECB has a policy meeting. So the Reserve Bank of Australia cut rates, the Fed cut rates, and the Bank of Canada cut rates. So it's likely we're going to get some policy action out of the ECB. Rates in the ECB are already negative. They're negative 50 basis points. So we don't know if they're going to cut anymore or if they'll increase their quantitative easing, because they're also doing a bond buying program, which may be more effective. So some people have said that they're going to wait until next week, their scheduled policy meeting, to make a move. Others said it could come this week, but it's getting a little late for it to come. So maybe next week. And that could, at the time, that could impact euro. If they make a policy move, that could weigh on euro. The next type of event risk is economic data. So the first type was the external shock, which is the coronavirus. And the next is event risk. The next type of event risk is economic data. So this is just out late last week. Everyone's worried about the extent of a China slowdown, and we don't know the extent. And even, policy analysts and research analysts at banks and at think tanks are having a really hard time kind of gauging the extent to which China slowed. It slowed massively. We just don't know to what extent, exactly how bad it will be. So China's factory activity slumped in February to the weakest reading on record. This was just released last week, March 1st. And analysts had thought it would come in at 45.7, and it shrank at the fastest pace on record. So much worse than analysts were expecting. So that's pointing to a pretty severe growth slowdown in China in the first quarter of this year. And how does that impact everything else? I think here it is. Risk for Australia. So I want to look at the Aussie dollar, and we're looking for risks to Australia from China. Now, Australia has had a really bad start to the year. That on the left, that's a photo from BBC World News of the bushfires. Australian economy was hit in the country by very bad bushfires, if you remember, at the start of the year. And now it's being hit by the gross slowdown in China that's resulting from the coronavirus crisis. And just the picture on the right is from NASA, and that just shows pollution over the provinces where the outbreak was initially started. And that's pre-outbreak with the pollution in orange, and then post-outbreak with almost very little pollution, no orange. And so what that's telling us is telling us that factories and people commuting, going to work is all come to a halt, essentially, which is very bad for China's growth. And that's certainly going to impact Australia, as China is Australia's largest trading partner. It accounts for over 30% of Australia's exports. So exports going to China from Australia is about 30% of Australia's total exports. And it affects Australia from investing perspectives and from commodity prices as well. So if we take a look at Aussie dollar levels, we bounced off that 65 level. You can see it was trending lower. Aussie dollar was getting weaker and weaker. And we hit a low of 65.07. And 65, the figure, is a really important level in Aussie, and one that should be watched. When the Reserve Bank of Australia cut its policy rate aggressively, 50 basis points earlier this week, we got a relief rally kind of in Aussie. I mean, it wasn't much of a rally. It went, like, say, just a big figure. But really, that's not much compared to how much it's fallen. And also, iron ore prices turned up a little bit as well, which helps support the Aussie. But my friends who watch iron ore prices very closely, because they're based in Australia and work for banks there, say that's just very temporary. Iron ore prices are going to come down with the fall in demand from China. So watching support at 65 in Aussie is really important. Let's see why. So here's a 15-year chart of Aussie, 15-year chart of Aussie. So you see there's no support under that 65 going back to 2009, basically. So it's a really important level. There was a low in 09 of 62.18. So there's not a lot of support under Aussie below 65. And so that's really interesting chart that, you know, that's why that 65 is the figure is such a big level in Aussie, and it's something I've been paying attention to for a while now, and I'll continue to pay attention to that. So obviously I'm biased downside on Aussie dollar. The news from China hasn't come out yet, so we haven't got the bad news. We got that bad PMI read, we got bad auto sales in China, which basically fell 80% for the month of February. The news coming out of China economically is not good. And eventually that will feed into the Aussie economy. We just haven't got the data yet from China, but those data will be released ahead. And when they are released, I believe they'll be very bad, and I believe that they'll weigh on the Aussie dollar. If I just look at Aussie is the red and green line again, Aussie dollar, and I'm looking at it against the Chinese currency, the Chinese renminbi, and it's inverted. So just stick with me on this chart. So the yellow line is dollar China, and it's on the left-hand axis, and I inverted it. So that means that, just to match Aussie, so that means that when the yellow line is going down, China is weakening against the US dollar. And when the red and green line is going down, that's Australia dollar weakening against the US dollar. So down, China's weakening, and downward, Aussie is weakening, and up, China's strengthening, and up, Aussie strengthening, okay? So they match each other directionally. So when the point of this chart is when the Chinese currency is weakening, it's really tough for Aussie to rally. It typically drags Aussie lower with it. So you've seen most recently on the right-hand side of the chart, Aussie depreciated or weakened more than the Chinese currency did. So that's kind of interesting. It'll be interesting with the growth slowdown, the bad numbers coming. You would think, you know, there's a chance that China might weaken its currency further because it's going to have bad growth numbers coming out. And that'll be interesting to see. And, you know, if China does weaken its currency further, that's only going to further weigh on the Aussie currency. They tend to move directionally together. I should note here, in terms of Australia, the Reserve Bank of Australia did do an emergency rate cut of 50 basis points. So just reviewing, Australia cut 50 basis points, Federal Reserve cut 50 basis points. No, I'm sorry, the RBA cut, 25 basis points only. The Federal Reserve cut 50, and the Bank of Canada cut 50 basis points, matching the Federal Reserve. And so coming up, we have the Bank of England and the ECB. So the next rate meeting will be the ECB. So it'll be interesting to see what they decide to do on the day as well. If we look at event risk again, the last type of event risk that I've mentioned to you is political and geopolitical event risk. So there's a lot going on in this category, and actually the end of 2019 and the very, very start of 2020, most analysts, including myself, thought this is the largest type of event risk we're going to encounter throughout the year. Why? Because it's the US presidential election. Also, there's Brexit, which we'll talk about in a minute. I know Brexit already happened, but there's Brexit negotiations are ongoing, and that's what we're going to talk about. There's also the US-China trade deal. Remember, we signed the US signed the trade deal with China, the phase 1 deal, on January 15th, and at the time, US equities were rallying. And at that time, we hadn't heard of coronavirus yet. That would come a week later. But at that time, analysts were turning their attention to, well, when does phase 2 start? The negotiations with China on the phase 2 agreements. So there's a lot in this category for the year, which is going to bring up continual event risks throughout the year. First, obviously, both the US and China and the rest of the world have to get through the coronavirus and contain it and control it for global health reasons. Second of all, there has to be, most likely, there've already been rate cuts in response to coronavirus, that external shock. The third thing that's probably going to have to happen on that external shock front is fiscal stimulus. So fiscal stimulus in the US, possibly China, possibly Europe, possibly Australia. So that's another thing the market will be looking for. In terms of the US-China trade deal, I don't even know if we'll start to get phase 2 this year, because the growth slowdown in China is so precipitous, is so strong, most likely, that they're not going to meet their targets for the phase 1 deal that they promised. So there's probably going to be, I don't know, some sort of rollback or renegotiation with the Trump administration about that phase 1 deal, because we're not meeting, they're not going to be able to meet all of those buying targets that they have in that phase 1 trade deal, because their economy is going to slow so much. And then on that front also, is the US economy going to slow? So prior to the coronavirus crisis, you know, employment had been really strong, the payroll numbers have been really strong, and consumer spending had been strong, and equities were rallying to new highs. But analysts knew, and we all knew, that the US economy was what we call late cycle. So, you know, we're really late into this economic expansion. How much more can equities run up? We were asking that question, but they seem to be running up, you know, higher and higher each day. And so things were getting a little, you know, precipitous. Things were getting, nothing was really wrong, but things were just getting a little toppy. And then coronavirus came, and I think the leverage in the system and, you know, was exposed. And we saw equities, you know, basically take some huge down days. Right now in the economy, underlying in the US economy, things aren't bad. You know, we'll have a payroll number tomorrow, which is a big risk event for the market, actually. And we'll see what that number is. I mean, if it comes strong, that's going to be good for equities. It's going to be good for the US, you know, market. It's going to be good for the Fed. But if payrolls start to weaken in the US, we have a whole other kind of political, geopolitical problem, which is the US is in an election year. The Fed's cutting rates. Certainly the Trump administration is going to continue to put pressure on the Fed to cut rates, and the Fed's going to in turn turn to the Trump administration because rates are so low already and say we need fiscal stimulus. And so that's going to be another political risk this year. But let's turn to a very clear political risk. This is a very clear example. We'll turn to the sterling and trading the sterling. But the political risk that's coming, one of them is Brexit. So we know that the UK did get Brexit done in a way. It did leave the EU on January 31st of this year. And celebrations were kind of muted. I think that they didn't want to mark the occasion. They marked the occasion, but not in a grand way, because it's obviously a very divisive issue for the country. So if we look at a chart of sterling, this is the pound versus the dollar, and when it's moving up, pound's getting stronger. And when it's moving lower, the pound is getting weaker. So January 31st was the Brexit day. UK did leave the European Union. And so I had expected maybe more of a little bit of a rally. I thought we could get to 134, like 133.50 on the pound that day. Just kind of a relief rally, like, yay, we're out, we did it. It wasn't really that day because it was on a Friday, but say trading when it opened Sunday night into Monday. And we really didn't get much of a relief rally at all in sterling. As a matter of fact, we hit 132 the figure and we dropped lower. So we didn't even get to the most recent high of 133.45 that you see there. So that told me that there's too much risk to be long sterling. Traders just don't want to be long sterling. If they're not going to rally, if sterling's not going to rally, if they're not going to buy it on Brexit finally coming through, then they're not really going to buy sterling. Since then, we've been in this 130 the figure, 128 range, largely, what you see there. We're kind of sitting more to the top of it. And that's just because this is against the dollar. And as I said, the dollar's weakening because US equities are falling. It's not really a sterling move, it's a dollar move right now. And so the event that's coming up for the UK is they still have to negotiate a trade deal with the EU. So when they exited on January 31st, really not much changed. They've started to change over passports in the UK, the covers, but really day-to-day goods and services transfers between themselves and the EU, nothing's changed with that yet. And so they're still negotiating that with the EU, and those negotiations started March 1st, and they're going to continue all year. But the relevant dates are June 2020 is the last month for the United Kingdom to request an extension in trade negotiations with the European Union. So what happened is that Boris Johnson, the Prime Minister of the UK, has said, we're not going to request an extension in June. He's already put that out there. And if he doesn't request an extension in June and they can't come to a trade agreement by the end of June, then that means they only have from June until December 31st, 2020 to negotiate the trade deal. So 7 months to negotiate, actually only 6 months to negotiate a trade deal with the EU. And that's not much time. The EU has said this is impossible to do. This timeline of 12 months into December 31st, 2020 is not possible to reach a trade deal. And Boris Johnson said it is, and we're going to. So we're back in that deadlock between the EU and the UK. And December 31st, 2020 is a hard deadline, meaning we're back with the hard Brexit possibility. So if they can't if they can't reach trade negotiation by December 31st, the end of this year, and the UK did not request an extension in June, then it's going to be a hard Brexit again, a hard trading exit from the EU, which is not what the market wants to see. So that risk is certainly going to, I think, continue to weigh on the pound. And, I like to be short the pound once, especially if this coronavirus passes, meaning if it, if it ends by the summer, or hopefully sooner than that by the spring. One of the market themes that are going to immediately rotate to the front is the Brexit negotiation into June, and volatility in the pound is going to pick up. And so if the UK does not request that trade extension for the negotiation by June, then that's going to heavily weigh on sterling. Traders are not going to like that. And you can see here all the downside levels of sterling that we can go to. You know, we can be back at 122, the figure essentially, very quick in sterling. And so that's why it's, while we're paying attention to coronavirus, certainly, and that's what the world central banks are fighting first, and that's what the equity markets are paying attention to. In the background, we have these other themes that are, you know, important, that once coronavirus recedes, will rotate to the front and will drive markets. And one of those is for Europe and for the euro and for the sterling is the Brexit negotiation. The other one that we've kind of seen this week is obviously the 2020 US presidential election, where Joe Biden came back, surprisingly, according to the polls, in Super Tuesday, and equity markets kind of rallied a little bit yesterday because Bernie Sanders was a little bit left on the back burner. So Bernie Sanders is not considered by the market to be a market-friendly candidate, and not, I guess, a preferred candidate for president by the market. He's a risk for the market. And so that risk receded yesterday, and we did have a rally in equities. So the other thing we need to watch for in terms of sterling is the Bank of England policy meeting. It's not until March 26th, but today I tweeted out, Boris Johnson did meet with the Bank of England and the Minister of Finance to coordinate a response to coronavirus. And so that probably means a rate cut is also coming from the Bank of England. And so the British economy is not doing very well either. A lot of investment was pulled out of it because of the uncertainty surrounding Brexit over the last year and the inability to come to an agreement with the EU. And now they're kind of getting hit with the coronavirus. The cases are rising in Britain. And so a lot of policy analysts think the Bank of England will do an emergency rate cut, so prior to this 26th of March meeting. So that's something to watch for as well. For sterling, that could weigh on sterling pretty immediately when they do it in the aftermath. So there's so much uncertainty out there. There's external risks, external shocks in terms of coronavirus. There's big, large geopolitical themes like US-China trade negotiations. To what extent is China going to slow down? To what extent is that slowdown going to impact Australia and how you can trade Australian dollar? The 2020 US presidential election. So you just need to be able to control what you can control. And that's why I made the Global Macro Event Risk webinar for clients. It happens once a month, intra-month, it's live. So I go around the world, you know, we look at what themes are occurring right now, the probability that that market theme that's driving the market right now will recede and something else will drive it. We look at the sub-themes that could come up and drive it, and we get trades ready for currently what's happening, and also getting trades ready to watch if those event risks or if those macro themes assert themselves as well. So the Global Macro Risk Event webinar, it can benefit you whether or not you're a macro trader. And the reason why I emphasize that is there's a lot of technical traders out there who I do meet and I do speak with. And sometimes they don't know which days can be the most volatile in the market coming up, or what days are likely to have market volatility. And so we can't always anticipate that, but we can look at big events that are happening, like the deadline for the UK-EU trade negotiations, the fact that they need to request an extension by the end of June. You know, we know there are certain patterns and certain geopolitical risks out there that take place on certain dates. Big rate meetings coming up, like the 26th of March is the Bank of England meeting, but they're more likely to cut intra-meeting ahead of that. So we know that there can be pound volatility over the next week as traders anticipate that event risk for the pound. We certainly know that payrolls is tomorrow morning or Friday morning. So that's a big risk event. So I give you a calendar of major risk events and what currencies it can impact. And that helps give you a trading map of days that can kind of be more volatile than others in the market. So you're ready, or maybe you have your own trade ready, and you may know this may help you see which days markets are going to move more than others. This will just add to your trading skill set. Just think of it as one more tool to add to your trading skill set. It's going to augment however you trade currently. And it brings Wall Street analysis to the individual and retail investors. So I have a lot of friends. I know a lot of people on Wall Street from my career. I talk to them. I see what they're looking at. I talk to my own private wealth advisors. I see what they're looking at, what they're telling their clients. And so I kind of incorporate all those plus my own views into this type of analysis that happens once a month. And so, you know, even if you have a trade that's doing really well, a trade that's in the money, a trade that you thought of yourself as making money, it can still succumb to event risk. So it's kind of that greed and fear. How long do you let a trade run? Maybe you need to take some of a winning position off ahead of this major event that could happen. So it helps you manage your trades as well. What you get with the Global Macro Event Risk webinar is a 60-minute webinar, which is live every month in the middle of the month. It usually happens anywhere from the 17th and the 19th. Access to the webinar is an email post-purchase, and it's held in the evening, 6:30 p.m. Eastern Standard Time. It typically goes about an hour. If you can't join live, if you join live, you can just ask questions on the live chat. If you can't join live, a replay is emailed to you half an hour after the webinar ends, and you can certainly just email me with any questions you have about anything in the webinar. You can go here to subscribe if you look at the webinar tab, and once again on my website, it'll have like a 2.5-minute video that kind of goes over a little bit more what the webinar is and what it does. And you've kind of seen from what I've presented today, it's a flavor of the webinar. We look at big levels, what could move currencies into big levels. You can follow me on Twitter and Instagram story for intraday updates on news, and also my little fledgling YouTube channel. Please support it. Subscribe to Market Compass on YouTube. Today, I wanted to talk about the major directional moves which are occurring in the G10 currencies. So that's what I reviewed. There are times in the market when relative value trades, so cross-currency trades, like say trading Australia dollar against Kiwi, so Aussie Kiwi or Euro Sterling, cross-currency trades could happen, like Aussie Canada, Aussie CAD. Right now is not one of those times in the market for cross-currency or relative value, it's called in Forex trading, relative value trades. Why? Because the market is moving so directionally right now that now is the time when traders, when macro traders, macro Forex traders want to catch big directional moves. Now is that time. Now is the time when volatility helps macro traders. And so trades against the dollar, trades against the yen are going to be very key in this time period. Trades against the safe haven currencies, whether risk is on or whether risk is off in the market. That's where, you know, the money is going to be made or lost right now. Relative value usually takes a back seat in these types of markets. But when things calm down and volatility falls once again, hopefully it will, eventually below 20 and equities calm down, US equities calm down, those are when comparative interest rates and how economies are doing, those things rotate to the front and we look more at relative value trading. But right now, trading, I want to say, is simple in Forex, but not easy. So simple, but not easy right now. Simple in that we're looking at G10 currencies against the dollar as most of the trades. So don't get too fancy with the trades right now. It's just the very simple things that are going to move and have large directional moves. And you just have to make sure that you catch them, meaning you need to be in front of your screens when markets are quite volatile, or if you have positions on there doing well, you need to know when to exit out of them, in order to capture those gains and not give them up. So right now, it's not easy markets to trade, but you want to approach this with a very straightforward, simple trading strategy, and be aware of event risk and be in front of your screens. These types of markets not all macro trading is sitting in front of your screens all day, but these types of markets being as busy and the news flow being as heavy as it is on a daily basis are kind of when you need to either be in front of your screen or pay very, very close attention to what the news flow is every day. And so what I do is I set alerts on my phone for Wall Street Journal, for Bloomberg, for CNBC, and I get my alerts that come whenever those headlines roll out. So I hope you enjoyed this. I hope you found some of it helpful. You can reach out to me if you have any questions about what I presented, or if you want to know more about the webinar. I'm going to put my email in the chat right here. And you can also sign up for just free content and read my blogs if you go to the front of the website. If anyone has questions, go ahead and ask. I think I ended a little bit early. But if you have any questions, just ask me. I left time for questions, but if there's no questions, I did end a bit early.
Okay, I'm going to go ahead and stop the